All right. Welcome back to another episode of the Hustle Harder Show. We have a great guest today. Very excited for this one. My guest is Nema Daghbandan from Lightning Docs and a partner at the Fortra Law firm. Very excited to have Nema on. He's a great friend and has a ton of awesome data that I thought would be really important for the conversation we wanted to have today, which is really a little bit of a recap of the first half of 2026. Today we sit in late July and thought it would be great to kind of go back and look at what's happened over the year or the half a year in 2026 and identify some trends and just observations. And I think Nema's data from Lightning Docs will be really important to help make some of those points. And then talk a little bit about 2026 second half of the year and kind of what we might expect from a lending perspective and for our real estate investor listeners as well. So Nema, welcome to the show. Super excited to have you. You want to give a little background on yourself?
Yeah, absolutely, James. It's great to be here with you. I'm looking forward to the next time you and I will get to see each other, which is probably about a month away or so. But very nice to meet you and your audience today. My name is Nema Daghbandan. I'm the CEO of a software company called Lightning Docs. Lightning Docs generates business purpose mortgage loan documents or investor loan documents, primarily for private lenders and non-QM lenders throughout the country. My background personally is I'm a real estate finance attorney. I'm a partner at a law firm called Fortra Law. And Fortra Law, as you can kind of imagine, is a law firm which services private lenders. We didn't stray too far from the software side of what we do. But thanks for having me and looking forward to our combo today.
Absolutely, Nema. I know Renovo, we were an early adopter of Lightning Docs, and we use you guys for the majority of the loan volume that we do, which has grown and grown. And so I know we work with your team all the time. Love the software, and it's been a great partnership. So thanks for all you do. And yeah, let's dig in a little bit. I think 2026 has been a really interesting year in private lending and for real estate investors in general. I think you've had a number of headwinds, still kind of a fairly stable foundation for real estate investors with the kind of supply demand imbalance that hasn't really changed much. So you've got some stabilizing factors, and then we've had a number of headwinds with geopolitical things which have impacted rates and a number of others. And I thought it would maybe just kind of be good to get into a few of the themes that I've observed from my perspective or my seat. And I know you've got some good data with the number of transactions that you guys are processing on a daily and monthly basis that I think can maybe shed a little bit more light and provide some backup for some of this stuff. But kind of kicking things off, I mean, I feel like one of the big things that we've observed for the first half of the year has just been intense and fierce competition among lenders to find assets to actually lend on. I feel like in the past, and maybe we're going back a handful of years here, but access to capital was always a major constraint for lenders, right? It was how can you raise enough money to meet the demand that you were seeing on the origination side. That has really flipped in the last few years with institutional investors really adopting and understanding the space and allocating a lot more resources in this direction. And I think that has flooded the market, for lack of a better word, with capital. And so, even some of the smaller, more regional lenders that in the past were probably raising money from individual investors and piecing together loans, those folks are pretty flush with capital, whether it's money that, relationships that they have directly or through loan aggregators where they're able to access liquidity. So it just feels like everybody doesn't feel like they have a capital problem. And it's more of how do I find good assets to put, this money to work in. From your perspective, I'm curious, like, have you been seeing that from your side of things? And, what are your thoughts around the competition aspect?
Yeah, so this is a really interesting one. And I'll take you back a little bit as well. So you and I were at the Fortra Law conference in August of last year. And funny enough, we had the Kevin Werner up on stage. And And I remember having my pre-meeting with him in July, and we also had Arvin Mohan with Kiavi. So the two of them were sharing the stage, and effectively the number one and number two lenders in the country, kind of sitting there and explaining their vantage points. And this is fascinating to kind of hear them. And they both basically said the same thing, which at the time was quite shocking to me, because they were basically saying, I'd asked them, what's your take? How are you optimistic? Are you pessimistic? How are you feeling about the market ahead of us? And they both said neutral. And I just remember thinking to myself, going, how can this be? This just makes no sense, because practically speaking, both of your organizations were flourishing. And I was like, how do you have these two businesses growing so rapidly? And they're both, I'm neutral on what's about to happen. And it's really wild if you remember, just take the clock back to 2025 one more time, which was the whole mantra of like 23 to 25 was stay alive till 25, right? That was just, if we can continue till 25, right? And it's like, I've never thought, and last year was not like it was an interesting year. The first half of last year, businesses were growing fairly quickly, both in their RTL volumes and their DSCR volumes in the first half of last year. But Kevin really did know something and have an appreciation that ended up being quite accurate, which was starting around the second half of last year, that growth rate dramatically slowed down, particularly in RTL. And so when you're now actually looking at the data now a full 6 months into this year, and you can reflect back. So I look at data in two different lenses. One is at Lightning Docs. So at Lightning Docs, we have roughly 330 lenders making loans at any given time. A lot of them are, of the RTL side of it, to kind of give you an idea of the demographic, a little less than half of the top 100 lenders in the country are going to be using the software. So it's pretty good barometer, but of course it doesn't have 100% market share. So one is I'm going to look at kind of what is happening in a same store sales environment. How did Renovo perform last year comparatively, in the first half of last year comparatively to the first half of this year? So what's happening with each customer, and then aggregating that information out and trying to understand is how our business is growing. Separately, we'll use an independent data source. So, for example, an Elementix, or, people use Forcasa or SFR Analytics or whatever, but effectively is a data source that is looking to the recording data of the underlying institutions and trying their best to try to, associate all transactions with different mortgage lenders. And it can give you the aggregated data, but it's not as precise, because my data is going to tell you, it understands what happened in the loan. My data set, I can understand, was this a construction loan? What was the construction holdback? I have a really deep understanding of what happened in that loan and can classify it with a high degree of certainty, versus a big data aggregator source is going to say, well, it recorded on this date, it was in this dollar amount, and we're going to make our best guess at what sort of attributes occurred in this loan, is how the big data aggregation occurs. But taking that aside, is both are telling similar stories, right? And that's usually what ends up happening, just because Lightning Docs is working with a lot of the larger companies. And so if you look at the RTL data specifically, right, and RTL I don't know how well versed I always feel like of these sorts of situations is I hate throwing out vernacular, but a short-term loan, right? It could be a construction loan, it could be a ground-up construction loan, it could be a short-term fix and flip, it could have no construction holdback, but basically a residential transition loan is what the acronym stands for. And the way I usually think about it, to simple it down, is, hey, what's a short-term loan? What's a loan that's of duration 3 years or less? They're usually 1 to 2 year loans, typically. And that's how you can best segment across these data sources. And so a short-term loan, and if you look at the Elementix data at least, and you look at that Q1 of 2026 compared to Q1 of 2025, the entire marketplace grew by 2%, right? Across about 1,100 lenders that they're surveying across, right? Our data had it closer to about 6 to 7%. I historically have kind of seen that occur, which is, generally speaking, our customer base will do slightly better than the marketplace altogether, probably because these people are thinking about technology and processes and all that sort of stuff. So I think they kind of tend to outperform the market as a whole. So that's the RTL story. So it's been basically flat the first half of this year. That is not the case in which, most people are not staying flat, if that makes sense. Most people are growing or shrinking, right? And so that's what's really happening. You guys obviously have your own quite compelling story of what's occurring with what's happening on the Renovo side of it. I'll let you speak more to that. But the interesting thing that is happening is there is a lot of movement, but what that movement that's occurring right now, so in years past, which would have made this quite different, is that we could have all grown together. And that's just not happening right now. You are effectively, if you are growing, which you are eating someone else's lunch. That's the way you're growing, right? You are fiercely competing in the marketplace for the exact same borrower base, for the same transactions. And thanks in part to people like your Elementixes and your Forecastas and all these things, your proprietary customer lists are no longer proprietary. They have been shared with the world. They are being deeply analyzed, and everyone has the same visibility about, oh, by the way, John down the street, that guy really has a lot of volumes. He is a high quality borrower. He knows exactly what he's doing. And so there's going to be incredible competitive tensions for the highest quality borrowers, because that's also, if you just take it to the capital market lens, we're like, where are all these loan buyers buying loans? Well, they want the highest quality loans. So yes, is capital available? Absolutely. And then effectively, it's unlimited with the caveat of unlimited for the best transactions, right? So
Yes.
It's making that tension incredibly difficult. It's when I talk to our largest customers, the ones that look and feel like you all there, the story right now is that it's a knife fight across these companies. And every deal is being shopped extensively. The ability to execute well is really separating groups right now.
Yeah, I think that's exactly right. You said a lot of great things there, but I think that's all very accurate from what we've observed. One of the trends that has occurred over the last probably 3 years, but is really, I think, hitting mainstream, is the access to data. There's so much more visibility now into the customer level of who is actually out there operating and doing that well, and that has been democratized. Everybody kind of knows who these folks are, and I think it really comes down to having a great mousetrap. You mentioned Kiavi. They have a fantastic mousetrap that is largely technology driven.
Yep.
Which speaks to a very, to a borrower preference. Like, there are borrowers who really love the technology aspect, and they are going to gravitate that direction. Our business is probably less technology forward and a lot more, localized retail, where, relationship driven, right? So we have different ways of attracting different kinds of borrowers with different preferences. But I do think having a strong identity and a good acquisition strategy from a customer perspective is critical. And then I think you hit the nail on the head. It's all about execution. And so the best borrowers, they get phone calls from every lender, right? Our customers tell us all the time, like, multiple calls a week, if not multiple calls a day, for the highest volume operators. And so they have choice. They have a lot of choice. There's no excuse. We've never been a big SEO group. Like, we don't do a lot of SEO because our thesis has always been the best customers, if they don't know where to get a loan, they're probably not very good, right? Because now the loans come to them and they have a tremendous amount of choice. And I think that's making everybody really stand on their merits in terms of execution and anything else they can do to add value. And that phrase knife fight, I've heard that hundreds of times at the conferences that I attend. And I think it's very descriptive of the reality. The interesting thing, and I think really speaks to the issue of a tremendous amount of capital, but a lot of firms kind of either staying flat or shrinking, and then kind of probably a smaller cohort that's growing, is, and the reason I think for that is that it's very difficult on the ground. Like, the folks that are out there actually acquiring properties and operating these investment, real estate investment businesses, they're finding it very difficult to find good projects, right? That pencil. You've had rates that are stubbornly high relative to what they were a handful of years ago. We haven't seen the reduction in rates that many predicted for a variety of reasons. And I think you've also got insurance and taxes and all the other inputs, materials, labor, all those things have been going up. And so if you're trying to run a business where you're acquiring property at a great price or below market value and add value and extract that, your margin has been getting squeezed really from every single direction. And so I think the reality that's always been interesting to me is there's a tremendous amount of exuberance at the capital markets level. it's like, oh man, these are great assets and these really hit a sweet spot in my portfolio and that exuberance is not mirrored with the reality on the ground, which is that it's very tough right now. And I think the best operators are succeeding and they're growing, but their profit margins are certainly being pressured. And so it's just harder and harder, I think, to produce great deals in this environment. And I think we'll get to this in a little bit, but I don't think that that's getting easier. And so I think the lenders that are winning are the ones that are able to really come in and provide value outside of pricing and terms, because that is getting more and more commoditized.
You were hitting the nail on the head. And it's interesting because if you look at these large origination shops, and you already identified it, which is, you've got your Kiavi or very tech-focused type lending operations. I would describe the Renovo as the hyper-focused on customer experience type lenders, right? So what you are seeing is that the differences in how you build your businesses matters a lot. And there's lots of successful ways to do this. It's not, the really hard things to do are execute very well in that cultural identity, right? It's going to be very hard for people to build at scale what Renovo has built at scale, right? Because maintaining culture across multiple offices, across going on a national landscape, it's hard to do when you're regional. It's incredibly challenging to do nationally. I'm sure preaching to the choir about how to, but you've done it, and the results are the results, right?
No, stop. No, no, you're absolutely right. We feel like we have built something that is very difficult to replicate. And that concept of identity has been really, really important to us. We are not trying to be all things to all people. We are trying to be great at what we do well, which is local lending, relationship focused lending, and excellent customer service and execution, right? And I think we've done a great job at that. On the other side of the coin, I think Kiavi's done an amazing job at the business that they've built. And it's funny because I do a lot of these panels at these industry conferences, and I'll sit next to someone from Kiavi, and afterwards we'll both remark to each other. Like, I think a lot of people think we're these kind of adversaries, right? And it's like, our businesses are so different. We're doing the same thing, but we're really going about it in two completely different ways. And I think that the way that we each do it, respectively, is really attractive to certain types of borrowers with certain types of preferences. And we are so different that we definitely have crossover, and we share customers left and right. But I think that though we each have a very strong identity, and I think that's always been very important to us, is to really stand behind that identity and be the best at it that we can. And I think that has definitely, helped us grow when I think it is a challenging market to grow. The key is smart growth with good assets that perform, though. And I think that's the other thing that I've seen over the last year. I think with this intense competition that you have, I think you have some of the newer entrants that maybe haven't been through down cycles in the market. The credit discipline of really focusing on great deals that are going to perform, great sponsors that have a track record of performance. That's the thing that I see sometimes, is like, you see term sheets and it's like, this term sheet doesn't make a ton of sense to me. But that said, those loans are getting done. And I think that will be a really interesting thing to monitor. Again, we might touch on this in a minute, but as we go forward in the year and into next year and beyond, I think, how well are these originations performing? And what is the ripple effect, from a capital markets standpoint, when you may have some operators that are not performing as well? We hope that all of our competitors succeed. That's always, I think it's important to have for a thriving industry, is you want people to succeed and all continue to grow. But I do think that's a story to monitor, because there's a lot of pressure to compromise on credit to get the assets to fulfill the demand that you have from the capital side. And I think that can be dangerous at times if you don't have a really strong kind of credit backbone, if you will. Yes. That's something we've always really worked hard at. But listen, it's hard. Sales team's pressuring you, the capital is pressuring you to put money out. And so there's a lot of pressures to compromise. And I think that's going to be really interesting, to see as we go forward, because I think those pressures are very real.
That's right. Yeah, and it's interesting, right? I mean, I'm sure from a sales perspective that it's, I think people oftentimes assume that interest rate is kind of the primary driver, and it's for sure a driver, right? But on these short-term loans, right, whether it's 1% or 2%, it can even be 2% lower than the competitor. When you really scale that out across the loan size, it doesn't make that meaningful of an overall impact to the profit of the underlying project, right? And so the one thing that really does change that dynamic a lot is the leverage that's available, right? What's the loan to value ratio, the loan to cost ratio? Those make big differences because that, the cost of that capital is quite expensive, right? And also it's the amount of cash on hand this borrower ultimately needs to have, right? And so you're ending up in an interesting market that is kind of becoming riskier, but also becoming less profitable, both at the real estate investor level, but also at the mortgage lender level, right? It's an interesting confluence of these downward pressures on both. It's definitely it's a tough time to be out there lending.
Yeah, absolutely. And you hit it right with the leverage thing. I think that's one of the other themes that I've seen throughout, 2026 and probably the second half of 2025 is like you are starting, in at least my observation, and I think you have the data to back it up, is average leverage levels to the underlying projects have been increasing.
Absolutely.
And I think that is definitely driven by competitive pressure, because at the end of the day, the borrowers, I think, value leverage more than they value price, right? They're willing to pay a little bit more, especially because these are short-term loans that typically are not outstanding for very long. 1% difference in rate is not a huge dollar amount in aggregate, in real dollars, but that equity, if they were to take an 85% loan versus having the option to have a 95% loan,
yes,
that extra 10% that they would otherwise have to bring in the form of equity, especially if they're operating at scale, they're probably raising that money or have investors, and that cost of that equity is significantly more than the cost of the debt. So they would much rather pay more on the debt side for higher leverage. And so you do see with all of these different lenders getting their capital from a wide variety, but not that wide a variety of investors that are actually institutional investors that are capitalizing these firms. You are seeing leverage levels increase because that higher leverage is available. And that definitely creates additional risk to the underlying loan and I think one of the things that people don't think about, it's not only that the borrower has less skin in the game. I think that's kind of the way a lot of people look at it, right? I want my borrower to be invested in this loan so that they stick through and actually, perform and sell it and I get paid back. But the other thing is like, it also limits your exit options, right?
Yes.
So if you're developing this project or renovating a home and you want to, you think you're going to sell it, it's really nice to have an option B or a plan B of renting it, right? But the higher the leverage level, the more that limits you on being able to actually get a 30-year kind of permanent financing loan that you're not going to have to put cash in to get.
I was about to say, is no borrower has ever asked for a cash in refinance, right? And
that is the last thing they want. Again, cost of equity, right? So
that's right.
I think that's where like you do see additional risk on the part of lenders because their borrowers are now they have in some cases fewer options or fewer good options to exit that loan in a timely manner, which again is going to really impact you on the capital market side. I think these are really interesting dynamics that are playing out. So, I think it's just been really interesting and it has really all come back to that competition that's being driven by the abundance of capital in the space right now. So we talked a little bit about loan volumes. Again, I think it's like, a lot of lenders are kind of flat, maybe down a little bit. Yeah, I don't think we've seen too many like blow ups, right? I think it's really just more, on the margins, if you will. And then you have a maybe a smaller cohort that is growing. But what other trends have you seen in the data from your perspective, over the course of the last kind of 6 to 12 months?
So a few different trends that, one of the things that we can track uniquely because of our data set is the actual price, right? The interest rates of these loans and what's happening there. So what you're seeing on the RTL side is a continued pressure downward. And also, so not only are the national rates going down, so right now they're right hovering about 10% nationally, and obviously different markets will change that dynamic. But in addition to the fact that the rates are getting lower and trending down, and it's been a very gradual decline for this year. It's been mostly flat. But the other dynamic that is occurring, and we kind of touched upon earlier, was that the dispersion. So, for example, what loans are being issued between 7 to 8% or 8 to 9%, et cetera. So the dispersion below that average national rate is definitely trending where there's a lot more transactions occurring at those lower rates, particularly for the more institutional level type customers and the borrowers that they want to work with. So there's a lot of downward pressure. Your DSCR side of that is less. DSCR is generally, and there's a lot of interesting thing happens in DSCR for those that, from a vernacular perspective, a 30-year loan secured by a rental property. That primary underwriting criteria is the debt service coverage ratio, which is what's the monthly rent divided by the amount of the monthly payment. And so the higher that ratio, the more rent it produces vis-a-vis the amount of the monthly payment due to the lender, the better quality loan, right? It's cash flowing, and the more cash flow the property produces a better quality loan. So for that DSCR loan, which is a lot of what we see as well, more than half of the transactions on our platform today are actually those DSCR loans. That's interest rate sensitive. It's been a very wild year for those purposes, right? The Iran war really kind of created a lot of volatility. You can generally track a DSCR loan. The best indicator is take a look at your 10-year treasury rate. And historically speaking, you were going to charge somewhere between 3% to 3.3% above the 10-year treasury rate. And that's how you would get to your average national DSCR rate. The interesting that's happened for those DSCR loans, at least this year, is that spread right there, that 3 to 3.3, has actually gone down. So what has happened is that the 10-year treasuries, because of all the volatility with the war, so when we started the year, it was closer to around 4, now it's about 4.5. And so there's been a lot of volatility in the wrong direction for purposes of those 10-year treasury rates. But the spread, what is actually required, is less. So right now it's hovering around 2.7% above that 10-year treasury. It will get you to your kind of national rate. So what that shows you, as we've been talking about, the appetite to buy these loans is there, right? So they're willing to take even less money and less of a coupon to be able to acquire quality investment assets, in this context, the DSCR loans. And that's the other side of the story as well, which is, and I'm sure you all feel it on the Renovo side, which is the conventional mortgage market, right, where the consumer market is incredibly rate sensitive, and most people are out of the money, right? At the end of the day, is most people are not have a home loan that is not 7% right now, and so there's not a whole lot to do there on the consumer mortgage side of it. And so if you're a consumer mortgage lender and you have 500 employees, you need to originate some dollars to make that make sense. And so what are they looking at? Well, can I originate anything at this point? What is available to me? The DSCR loans is the thing that makes the most sense for them, because they can go back to their distributed network of account executives and counterparties and say, hey, do we have anybody that needs a rental loan instead, an investment loan instead? And so they're making a very large play and a push. And they're, by virtue of being in a very large traditional market in that consumer mortgage side, they have capital partners and institutional partners and everything. So they're bringing a sophistication and apparatus with them that lets them compete very heavily, which also probably helps push down. That's probably why we're seeing a lot more of that kind of push down to 2.7% instead of 3 to 3.3%. Is that market's also hyper competitive, but that one is pulled back a little bit. And if you look at Q1 of this year, we were tracking those DSCR transactions across same store sales. They are up about, call it 40 to 50% per month. So doing really well. The first start of the year, Iran war starts, right about March or so, and that changes that dynamic. And so it was still growing. So when we were tracking, it was about 20% or so in Q2 year over year. So, but that rate of growth definitely slowed down. And you'll see that pendulum swing wildly, right? So if you get rates again if you can get 6 handles on that number, right, you're going to see a lot more activity on the DSCR market. That it kind of continues to open up because there just is a lot more rate sensitivity in DSCR than there is in RTL.
I absolutely agree. And I do think that that's a trend that I think we should all be looking at going forward is conventional lenders really encroaching on market share for the DSCR loans. That's definitely going to be interesting. One of the other components of that debt service coverage ratio for many lenders is going to be taxes and insurance, which have been going up as well. So you've got rates remaining stubbornly high. You have taxes and insurance going up all over the country, maybe not in every market, but a lot of them. Sure. And in some markets, you have an oversupply of rental housing that, occurred really starting back in kind of the 2021 timeframe. A lot of apartments went on the ground. So a lot of competition driving rents down. So you've got, again, pressure for rental property owners really coming from every angle. The other thing I think that's really interesting about the rate story is not just rates in a vacuum, but it's rates relative to the leverage on those loans. Historically, you would see the higher the leverage, the higher the loan to cost or the loan to value of an underlying loan, the higher the price would be. Because there is so much intense competition, and to your point from a moment ago, the institutional investors that are capitalizing a lot of these lending firms really are, very focused and have a huge appetite for experienced operators. Those experienced operators have the most optionality, the most choice, and I think you're seeing that they are now demanding higher leverage and lower rates. So you have rates kind of coming down or being compressed, certainly seeing pressure, and then you have pressure to the upside on leverage. And so as a lender, you're getting paid in some cases less for more risk. And that is a very interesting dynamic, which makes, I think, different, swings in the real estate market broadly more painful. If you're originating too much high leverage and you're not getting paid for that risk, and you see a big switch in terms of the underlying value of the assets, or there's a number of factors there. But I think that's another really interesting dynamic that we've been seeing play out. So again, I think it's a lot of pressures on originators to get it right, to value the assets correctly, to understand the rental markets when you're talking about DSCR, in order to mitigate that risk of leverage creeping up and price kind of creeping down. You've got to really carefully manage that stuff. And I think that's something that the best lenders are good at. No one is perfect at. And so I think we've all got to be really, really careful about, how we're evaluating and underwriting these loans to make sure that we protect ourselves in the event of a turn there. And I think that's another big story that we should be paying attention to.
Yeah, you hit it. I mean, the comment you made earlier, I think, is one of the more interesting ones, which is really just this concept that I think the tension that particularly your originators who have historically had balance sheets or continue to have balance sheets independent of any sort of secondary loan buyer, right? They've always lived in a world of managing and understanding credit risk. Right. And that's just the way that they live their life. It just says, look, I'm never going to race to a higher leverage position. It just doesn't make any sense. I'll just continue to pass on those deals because that's just the mindset. They're trained really well to understand and fixate on credit. And what's interesting in the capital market system is that it's not necessarily that they're making poor risky choices, right? But they're willing to take on a higher level of risk than I think your traditional originators that have balance sheets are willing to take. And they have rationales for it. It's not that these people are not dumb. They effectively are aggregating data and sourcing enough and saying, look, what is the historical loan performance of loans with this sort of leverage in this sort of market, right? That's what they're basing it on. They're basing it on large data aggregation to come to that conclusion about why they are personally comfortable taking on higher leverage. But it's a different conversation, which is almost like, what's my money? What's your money, right? I think that's kind of the lens, right? Because ultimately, is at the institutional level, you're really managing others' money, right? It's not personal to them. Versus you as the operator, particularly when you've had that kind of balance sheet mindset for so many years, it is my money. I am a fiduciary, a custodian of this on behalf of my investors, right? It's very personal in nature, right? You look at those default rates, and it's interesting because if you're at an institutional level, you're looking at this investment as vis-a-vis any other investment, whether it's an RTL loan or a credit card, right? Like it is just an investment vehicle that has a risk rating to it. It has, its own maturity to it. Like you were looking at comparative to all these other assets. But if you're a loan originator and a lender, right, you're like, these are the loans that's secured by this house, right? It is much more acute, and they have a different deep subject matter expertise of the actual underlying loan. Right. So that tension it's got to be a painful one. I actually really do not envy being in your shoes today. I think it's got to be a very challenging market where you effectively know better, but have to continue to play and operate in a very dangerous place.
Yeah, absolutely. I think there's a lot of risk out there right now, and I think that's why the best originators and the best lending firms are gonna be built around a very strong credit backbone. And I love that lens that you put on it with kind of it's less personal to the institutional investor, and they're looking at things more in aggregate as well. But the originators that do have history as a balance sheet lender or treat the capital that they're lending that way are going to be more. It's going to be more personal, and I think that does impact the decision making in terms of risk. But again, I think there's just opportunities to stumble at every turn. And so I think, maintaining that discipline, and we use that word discipline a lot, is incredibly important. And, it's hard to get it right most of the time. You're never going to get it right all the time, but it's hard, I think. And it's getting harder with all the pressures that we've described today. You mentioned loan performance and default rates and things of that nature. What is the data that you're looking at kind of tell you around performance and how that's evolved over the last 6 to 12 months?
Yeah, so this one is more my natural curiosity. In Lightning Docs, there's nothing in there. You're only using me to generate a set of loan documents, and we're all wishing everybody that loan pays off at some point, right? But I actually don't know whether it does or doesn't. So in this context, what I'll do is I'll look through data aggregation and data providers to see what is happening. Because in this context, if you're going to initiate a foreclosure, right, you're either going to in a non-judicial foreclosure state, you're going to file a notice of default. And if you're in a judicial foreclosure state, you're going to file a judicial foreclosure lawsuit, right? So there's an event, it is public in record, and that's what you're going to aggregate off of. It's not going to tell you the full story, because if you want the full story, you'd want to understand not just defaults, right? So filing a foreclosure action is a pretty extreme measure, right? It doesn't tell you, for example, what is the delinquency, how late are these loans? You don't have that context, right? But if you just looked at the foreclosure related activity that is becoming part of the public record, I'm going to give you two different numbers, and I think it's going to be really demonstrative of the story. So one is 50%, right? And 50% is the growth in foreclosure activity from Q1 of this year compared to Q1 of last year. And you're like, oh no, right? Like it's coming, that's the fourth horseman, right? And so, but when you actually look at the other number that pulls up is, I think it was 2%, which is what is the actual overall portfolio and foreclosure of all loans, right? So it's still a historically fairly low number, and it's going to be varied across different lenders, right? So certain lenders, we talked about credit a second ago, certain lenders, particularly ones that I think have primarily focused a gain on sale or a secondary market play where they're selling most of their paper, right? Those are the ones that are having higher foreclosure rates than others. I don't think it's anything particularly alarming yet. There's nothing that I've seen in the data. It seems quite healthy. And, we always throw around the term, like, is it kind of at or near your 2019? That's like the last time we had a normal baseline of what foreclosure activity could or should look like. It's around 2019, right? So that's what we're seeing on the underlying data, which is good. I don't think people were panicking then about what was going to happen in the markets. That's not to say that things couldn't change, right? I would say is the affordability environment that we live in, just in general, is a lot worse than 2019, right? So that dynamic is obviously different. And so you can't compare the two, but at least in terms of the raw numbers by percentage basis of all originations compared to what's the foreclosure rate, the numbers still aren't that big, even though obviously, they grew a lot year over year. So if we're finding another 50% next year, we may be having a different conversation than you and I are having right now. But as of right now, the actual total numbers still aren't that high. I think that the interesting part of, the secondary market is that it can react pretty quickly to these data points. And so what happens is, when I talk to a lot of lenders who primarily sell their loans, what they will tell me is that, yes, there's large pools of capital available. They are becoming much more selective in what they're willing to purchase. And so they are also quickly coming around on credit risk and those sorts of issues and limiting the amount of capital or trying to reduce the risk. They are kind of responding to the market in real time. So I think you will see that pendulum move back and forth as data comes back through and you start seeing foreclosure rates tick up, delinquencies tick up, those sorts of issues. I think the capital markets will start responding to that tension and applying that pressure back to the originator.
I think that's right. And anecdotally, that's certainly what I'm hearing when I talk to folks when I'm out and about is, the loan buyers are being a little bit more selective. They're starting to ask more questions. For the last few years, the market has been performing pretty well. I think it's at the capital markets level, it's been a little bit of a party, right? Everybody's having a good time. Loans are performing really well. Not really, they're certainly paying attention, but maybe not putting the microscope on every asset or, what have you, until they start, to your point, start to see trends, start to see some of these things tick up. And then it's like, okay, that's a little bit of a yellow flag. Like maybe we should start paying a little bit closer attention. And I think that translates to more questions, more scrutiny over documentation and underlying underwriting criteria, things of that nature. And so I think in that market, in a market like this, where you are starting to see that trend maybe start to develop, you do start to see a little bit more potentially like discipline being imposed from top down, as opposed to it kind of all being on the originator, which I think can have varying results depending on the quality and experience of that originator, right? So
That's right.
I absolutely think that's a trend to watch. Delinquencies, I know from your seat, are a little bit harder to see. One of the things I think that, can give you somewhat of a barometer there is, there have been a lot of securitizations. Securitization activity has picked up a ton in the last 2 years. Last year, I think it, maybe doubled what it was in 24. I think there's a significant growth rate, that you're seeing this year in terms of new issuances and originators that had never issued before who are coming to market with securitizations. The interesting thing about those securitizations, which again, for those who don't know, right, you can finance a lending company through balance sheet where you're actually raising and taking custody of investors' capital and then lending it out off of your balance sheet. You can sell loans to the secondary market, be it aggregators who then turn around and either securitize or sell, or you can sell directly to asset managers, insurance companies, or you can securitize yourself, right? Where you pool a bunch of loans and then you go sell securities off of those pooled assets. And because in the RTL world, these loans are short-term in nature, those are all structured as revolving vehicles, right? So you might put in $200 million worth of loans that fit some credit box that you define for your investors. As loans pay off, you basically replace those loans with another loan that fits the same criteria. Those are typically, there's a lot more visibility into how those assets perform. So you can typically get a little gauge of like delinquencies and things of that nature within those securitizations, which I think is kind of a sampling, certainly not going to be broadly applicable maybe, but it gives you an idea. Those are not always the best numbers though, because as an originator, if a loan starts to go delinquent, you have covenants and different things you can trip where you can't have a certain percentage or over a certain percentage of delinquent loans. And so as loans start to maybe struggle a little bit, you can pull them out and replace them with another loan so they can adjust those numbers so that they're staying within, kind of the guidelines of their securitization. So they're not perfect. But it does seem through that data that you are starting to see a little bit of a tick up in delinquencies. And then again, anecdotally, I think you hear folks, talking about their delinquency numbers. I don't think anybody is broadcasting their delinquency numbers, for obvious reasons. But I think you are starting to hear like there are some more challenges, and the asset management teams and workout teams are busier today than I think maybe they were a few years ago.
Yes.
And so these are a lot of like kind of pulling together, the tea leaves a little bit, but it does seem again, and it makes sense against the broader backdrop of, I think, a more challenging market on the ground for the operators to succeed. And, as margins get thinner, you're going to just see more, I think, challenges. So I think that's another kind of thing to watch going forward. The last thing I wanted to touch on here is there was some pretty big news in our space where Kiavi, who we've spoken of a number of times, did a transaction with Figure. That transaction I don't believe is closed yet, but they did announce it several weeks ago. Has certainly made headlines in our industry. And it's been a topic of conversation, pretty frequently. Any thoughts on that transaction and, kind of what that means for the space?
Yeah, so this was obviously a really big one, just sheer size, right? Kiavi being the largest RTL lender in the country, and that in of itself was very headline. But this one to me was quite different than I think what people are treating it as. So there's been a lot of purchase and consolidation in the space, particularly because there's all this institutional capital coming in. And so traditionally what would happen in these marketplaces is a lot of these loan originators effectively have their secondary market counterparties start growing these really great relationships together. And at some point that secondary party says, well, why don't I just own some or all of your company, right? It's just logical sense. Let you be the extension of my institutional investment, right? You're my origination arm effectively. And we've seen a lot of that over the past, 5 or 10 years. That's what most of these plays look like, is we already kind of the buyer of my paper. So might as well end up in a situation where we're more married together and have a tighter alignment around the economics, which makes perfect sense. This is not that. I mean, there may be a component of that. I don't know what volume, if any, Kiavi was selling to Figure, but I do not think that is what was happening here. And this is very different. So we've talked earlier about Kiavi being a high technology play, right? And so what they've went into market and says, look, we're going to build a really, what I would call consumer-esque type front end, where you can, if you go and buy a home, right, your chances are most of that is being done through the computer today, right? So most of that process is being done digitally. It's a really kind of humanless encounter as much as possible, right? And I think they kind of try to mirror some of that efficiency for purposes of private lending, which is really hard to do. That's a lot more of a discretionary business. So I really, hats off to them for building a lot of technology and to try to build that digital experience of borrowing money for these sorts of RTL loans. And if you think about Figures, they've been doing the exact same thing, except on the capital market side, right? So they're one of the first to really actually use blockchain. Blockchain's been talked a lot about in this industry. I've talked a lot about it in terms of where I thought the future of mortgage ends up at. So blockchain for, this isn't a conversation necessarily to get onto, but really is when you think about mortgages are oftentimes sold to other companies. And we talked about securitization a second ago, which is not only can the mortgage be sold to another company, but you could take a single mortgage and you can divide up a single mortgage. You could say, hey, I will sell different portions of the risk of this mortgage. So if only 50% of this loan pays off, well, one buyer of this piece of risk will get paid in full, but the person who owns the bottom 50 of the risk, well, then they are going to get a haircut, right? So you can cut up a mortgage, and that's what securitizations really do efficiently. Is they say, look, there's different types of loan buyers or institutional bond buyers with different appetites for risk and tolerances and money allocated for different types of risk, and it lets you take an entire pool of 100 loans or 200 loans or whatever and split apart risk assets. Well, that's great, and that's really efficient, and there's a whole market for it, but it's very expensive, and there's a lot of transacting, there's a lot of paper that comes along with that, right? And so that's one way to do it. There's another system which, a lot of people are probably familiar with or have heard of called MERS. So MERS is just a private company, right? So MERS allows people to place a loan into the MERS system, and MERS can handle the movement of that loan. And it says it's a Renovo, but now it's moving over to this party and over to this party and over to this party, and it moves the paper. A lot of DSCR loans are written into the MERS system and allows this kind of frictionless movement of the loan along the way. Most consumer mortgages are moving in the same way. Blockchain is just a distributed ledger. So basically what it allows for is it allows for the movement of an asset. Whatever, it could have been crypto, but it could be a mortgage loan, but there's an asset and an ability to move the asset very quickly, right, in an open and transparent way, a public ledger that everybody can see at the same time. And so what Figure has been doing in the background for the past few years has been building the actual underlying foundation and getting capital markets acceptance, getting real buyers in their system, buying real loans off of this technology. And so what you really married was a very, very slick technological front end of origination with a very slick technological innovation on the capital market side. And those two parties came together. And that's interesting. It could be what's going to happen is anyone's guess. Lots of different things happen post M&A for these companies. Sometimes it's good, sometimes it's bad. Sometimes companies fall apart shortly thereafter. Anything could happen. But the technology piece that really happened in the background, that's the story. That's the really impressive, what the capabilities of these two groups coming together is what I'm most interested in understanding over the next few years.
Yeah, very, very interesting transaction. I think a lot has been said in conversations, and I'm sure there's been just a lot of talk about it. But it is going to be very interesting to see the outcome and two very interesting and complementary parties, I think, getting together here. And certainly, to your point from the beginning of this part of the conversation, I think the scale, Kiavi being by volume, but the largest originator in our world of lending, it makes for a very compelling story. Fascinated to see how it turns out, but definitely going to be one to watch, I think, going into the future, not just the second half of this year. Kind of wrapping that up, but I think moving to, what do we expect, going into the end of the year, second half of 26, going into 27. I think we've kind of throughout the conversation, we've touched on some of these things, but, what are the main kind of things you're tracking or thinking about in terms of some of these trends playing out going forward?
The real outlier and the unknown that creates a lot of havoc right now is the continued pressure on oil prices caused by the war, right? Until it's effectively impossible to write a narrative until the conclusion of that occurs, right? So, when we were a month or two ago and it seemed like we were at a standstill, there was some predictability kind of re-entering the markets. You saw that occurring with the treasuries coming back down. You saw that, I think there was just sentiment. There was a real kind of sigh of relief. And now we're, as you and I are talking today, it's very much on, right? And so that volatility and, when we fill up at the pump and everything else, that creates all this drag on consumer sentiment. It makes what feels already unaffordable even more unaffordable. And so, it's really hard to make any useful prediction as it pertains to what the second half is until we get to some finale as it relates to the Iran war and any kind of oil price shock and inflation shock that kind of comes with that. But I will say the interesting story, I think at least I really dislike when people companies really focus on the market as the primary indicator of their success. I will point to you all over there, Renovo, right? I mean, you grow good market, you grow a bad market, you figure it out. I'm sure it affects your rate of growth. I'm sure you could have grown faster or slower. And so it's not that it has no effect on what you all are doing, but good operators figure out how to make good loans regardless of the market. And so I really think it's a cop-out when people focus entirely on market dynamics.
Yeah, I don't disagree at all. I think that's certainly the way we try to run our business. But, I completely agree with your sentiment that geopolitical factors are definitely a big risk. And I think the one thing that maybe we can kind of count on probably or is most predictable is not like the outcome, but I think volatility. I think volatility is going to be a major component of the story. Well, I think we've seen that through this administration. There's a lot of volatility. A lot of things are said. Things come, go, happen. They don't happen, right? I think everybody's always kind of guessing and a little bit on their heels. And I don't think that that's going away, even when you have a conclusion to the Iran scenario. So I think volatility is something we should all be planning on. We certainly think a lot about it, but at the end of the day, from a lender perspective, from the seat that we sit in, you have to make good loans. And We have, fortunately, like a very good track record of writing loans that perform, but you're only as good as the last loan that you wrote, right? And so, I think we have a saying internally here at Renovo. It's 1,000 details. There's 1,000 details that happen every day behind the scenes, and the only way we ensure our success or give ourselves a chance at future success is we have to take care of those 1,000 details every day, no matter what is happening. And I think if you're doing those things well and you're really focusing on the fundamentals of underwriting and credit decision making and working with good sponsors and all of that, then you should be okay. And I think,
That's right.
Our business model being highly localized with, we really know our customers personally very well. We know the assets very well because we live in the markets that we're lending in. That's one of the best ways to mitigate risk is know your asset, know your borrower. And I think we do that very well. I think a lot of participants in the industry go about that in different ways, but many do it very well also. And I think those are the key fundamentals that I think are going to keep people out of trouble as we move forward in what is, I think, going to be a fairly volatile environment. And that's I think what it all comes down to. Absolutely, these things can have an impact. Sometimes good, sometimes bad. But I think if you're taking care of the basics, you give yourself a good shot. I think we touched on a lot of this loan performance. I think loan performance is going to continue to be a great story to watch. No prediction from me on where that goes. But again, I recognize a lot of these pressures, both from the lender perspective related to capital markets and things like that, as well as at the borrower level, the pressures that they face. And I think it's just going to make it imperative that people are very on top of their underwriting and their credit discipline. These will be really interesting things to watch. What about consolidation? Do obviously this was a huge, deal, the Figure acquisition of Kiavi. Do you see more consolidation occurring? I mean, I know to your point, we've had a lot of capital providers that, the way I think about it is, the originators are the manufacturing plant, right? We manufacture the widget, which is the loan. The loan is then acquired by somebody who is going to do something with that widget. And so folks that have been buying loans have definitely had an interest in acquiring the manufacturing of those loans to have more control there and to get more efficiency over the economics. I think I would assume that should continue. But do you have any thoughts on, future consolidation?
I think that the traditional story will continue, right? Which is effectively is they may make headline risks, or they're not headline risks, but they may make headlines, but ultimately what you really have is probably a deeper marriage of capital source and originator. And so it's really not actually all that, it's not really news. It's just tying economics better together and having more of an alignment there. I think we'll see a lot more of that because we really haven't seen, when we think of M&A, we oftentimes we're not seeing a lot of the M part, right? We're not really seeing companies, your East Coast company coming together with your West Coast company, a lot of the stuff you would see in a more, traditional public market type setting. We're not seeing a lot of people joining forces per se. What we're really seeing is your originator and capital provider coming together in a more meaningful way. And I suspect that will continue for some time and continued interest on that side of it, right? I mean, I think that if you're a capital provider, and especially someone that has assets under management, you have to deploy it, right? So if you can find quality assets and quality originators, you will still see that change of hand, right? So you will see people switching their institutional capital provider, right? But that's going to be a lot of the story rather than, I think, Renovo is not joining forces with Kiavi. I suspect it will not be the second half of 2026.
No, I don't think that's on the bingo card.
That's right.
But I think your point is well taken. I think that type of M&A of capital providers and originators kind of teaming up, that I think is going to continue. I do think that the Kiavi-Figure partnership is basically echoing the points that you made, very unique in that the way that came together and the synergies that they're looking to take advantage of there. I don't know that I see another one of those, but then again,
Agreed.
You never know. We continue to see, I think, growth in terms of interest in the space from the capital perspective, and we'll see how that plays out. But Listen, Nema, this has been a fantastic conversation. I think we covered a lot of really interesting things. I very much appreciate you lending your expertise and your visibility to the conversation. And any parting thoughts from your side, or interesting things that you're working on you want to share with the audience?
We didn't really touch a lot on AI, but I think that's where a lot of attention is right now. And AI has been around, obviously. The discussion of it has been around now for a few years. I think that the momentum behind it has changed a lot in the past 6 months. I think people are finally getting to a place of going, okay, I now actually understand how I can start using it in my business. I'm going to start using it. I think Claude Cowork was the big driver of that, where you could easily give an LLM access to some proprietary data of yours and feeling fairly comfortable around doing that, and then asking for an analysis to be done on your data, right? That's kind of what a lot of people tinkered with. Obviously I'm in a software company. We work with a lot of developers on our end. That the stuff that they're spinning up is just incredible. I mean, the democratization of code is really here, because I've got a lot of people who are really almost like quasi-legal or paralegal type developers, right? Their real skill is in writing language and loan documents and understanding the rule sets. So they're very math inclined. And that was really their skill set versus your traditional, call it software developer, which is go build a piece of workflow or go build a piece of software that I interact with. But these same people now are actually developing software without any formal training, and it works. I mean, they build it, in just 1 week, they built, I think a lot of people use project management software, right? So with Airtable or Zoho or whatever to manage projects internally. They effectively built one that was really oriented around our systems, which is, can we have a customer-facing interface that has them give us a piece of information with attachments, and we can communicate with them and attach their emails, and it sends them emails. And they built it in a week. Like, it is amazing to see what's going to happen in all of these businesses and the private lending businesses, et cetera, that like just this application of AI. I'm really excited, and I'm hoping that when we start going to these industry events, we start seeing and hearing more of that, which is, what are we actually doing? How can it be used? Because I just think it's such an exciting time to be in business, right? I mean, the productivity of companies and individuals is really going to magnify over the next few years.
Absolutely agree. I feel like every conference I go to, there are new companies that are coming out with amazing applications of AI and ways to tailor it to the unique challenges that we have in the private lending world. That is only going to accelerate as adoption continues to grow and people get more comfortable with, the data security and things of that nature. I think that was a big challenge early on in terms of adoption. I think a lot of that stuff is starting to metabolize in the market, and so it's always interesting. I'm very excited to get to your event coming up in Newport Beach. I expect that we'll see a lot of really great kind of technology applications and companies that are entering the space or coming out with new tools and applications that are very exciting. So that's one of the things I'm excited about. But always you guys put on a great event. What are the dates of that? Fortra.
The Fortra Law event is going to be the 25th and 26th. A really fun change this year is we're going to have a golf tournament over at Pelican Hill. I don't know how to golf, but I will be there, presumably handing out cigars or otherwise giving people a hard time as they try to golf is my primary mission while doing that. But it's going to be the 25th and 26th. We're actually going to be talking about a lot of the things that you and I talked about today. I'm going to be doing, funny enough, an interview with Figure, kind of a one-on-one fireside chat with one of the folks at Figure to get their perspective on our industry. I'll also be doing a one-on-one with a large private lender in the space about their use of AI. How are and really kind of more that technical, tactical detail. Is it going to be using to kind of call people? Like, what is it? How are you actually using it? How are they thinking about building it? How do you provide a context? All that kind of stuff. So should be a good one. Hopefully we'll get, I know a good portion of that Renovo team will be there, and it'll be exciting to see you all.
We have a big team coming. They're all very excited. And you guys always do a great job putting on a fantastic event. So certainly for anybody who's participating in the space, really from any angle within the ecosystem, it's a great one to attend. So looking forward to seeing you in person here shortly. And thank you very much for spending some time with us today, and really appreciate the insights.
Thank you, James. I really appreciate it.
Absolutely. All right. Well, that's all we have today. Thank you very much for tuning in, and we will see you on the next episode of the Hustle Harder Show. Cheers.